All righty. Welcome, everyone, to this week's edition of the Business Owners Mastermind Call, the 10X Business Owners Mastermind Call. This call happens every single Tuesday at 10:30 a.m. Pacific Time. And so I want to welcome you to this week's call. This call kicks off our new format, which is we're bringing on a guest expert every single Tuesday. And this week, the first person to kick it off is my good friend Jovan Greenleaf. Jovan is out of Modesto, California. She is a business tax expert. So all your tax questions, that's what you want to be coming to the table with. For those of you that are out on Facebook Live watching this, put your questions in the thread there. Ashley's going to be monitoring those questions, and then as we go throughout the call, let's go ahead and start taking those questions, Ash, and we're going to have Jovan answer them. So, Jovan, you there?
Yes, sir.
All right. Can you take a minute, briefly tell everybody about your background, what led you to get involved in tax, and then we'll get going here.
Oh, absolutely. Well, I started off in computer science. I got a degree from USC. And then I wanted to go into business for myself because there's just so many tax advantage for doing that. So I opened a business helping the mental emotional disturbed, and I needed to know what to do for business. So that was almost 20 years ago, and I started taxes. And from there, I continued to do that business, but do taxes as a part-time thing. And then I ended up doing my own business about 7.5 years ago and specializing in helping the small business owners and stuff. So I've been doing this on my own for 7.5 years, and I love doing taxes. I like finding out the different advantages that we can take and lower our taxes big time and keep our money that we make.
Yeah, so most people don't realize that there's two different types of tax systems in this country, and one of them is for the employee, and one of them is for the business owner. And so once I learned that, you know what, I'd show up to my job, I'd work my tail off, at the end of my pay cycle, I'd get my check, and the lion's share of the money, well, the big old chunk of that money went to the I, R, and the S. And so I'm like, this sucks. And so I'm like, once I learned that, hey, you know what, as an employee, you go to work, you do your job, you get paid, they take taxes out, and you get to survive on what's left over. And once I figured out the secret to wealth and business is you work your tail off, earn as much money as you can, spend as much of it as you can through legal tax loopholes, which we're going to talk about today. And then you pay tax on what's left over if there's anything left over. The goal is not to have anything left over.
Exactly. And as an employee, you look at your check and you say, who is this Fuda? I've never met him.
Mm-hmm.
I've not met Uncle Sam, so why should he take my money?
Yeah.
So as a business owner, you want to hold on to as much as you can, and we're going to talk about some of those strategies to do that.
Yeah. And so that's one of the things, that's the reason why Donald Trump did not want to release his tax returns, because he didn't want everybody to see that he wasn't paying any tax. He was taking full advantage of the rules that are out there and the stuff that we're going to talk about today. So let's talk about what the differences is from a tax strategy as it relates to, you know, you're a sole proprietor, you're an LLC, you're an LLC partnership, an S Corp, or a C Corp. What's the different tax advantages with the different structures?
Well, one of the main different structures is that you get to write off different things for each company. So it's the same thing with a sole proprietor. You get some of those advantages as well. So, like, for instance, one of the big things is when you own your own business is hiring your kiddos and keeping your money, or getting into tax-exempt tools where you can save on taxes, tax-exempt. That's what we want. We want to have tax-exempt. And when you have your business, your corporations and stuff, you get to set up those plans for yourself and some of your executors, and that helps you lower your taxes.
Mm-hmm.
Well, as to just a W-2 worker, you can't take advantage of those things.
Yeah. So now, if I'm a sole proprietor, right? So, there's a lot of businesses out there that listen to this show and then subscribe to the podcast. And so what would you say to the sole proprietor out there that's making less than $100,000 a year? Would you recommend that they continue to operate as a sole proprietor, or would there be any advantage, and I think I already know the answer to this, to them forming a corporation at this point?
I would say if you're up to the 100,000, you want to form a corporation because you want to protect your money and protect yourself from lawsuits and stuff.
Mm-hmm.
So definitely there are advantages in doing so. And it's I don't know if you heard about the veil, how you want to hide yourself behind the veil, because there's always predators out there looking to sue you for any reason that they can. They come into your company and they fall.
Yeah.
So now your money is not protected. So,
yeah.
But as a corporation, you're protected from that because people are, doing all kind of things to free you from your money.
Yeah. Yeah. I always talk about there's three different phases to business, and one of them is very, very dangerous, and that is you're in that startup phase where you're just starting and all the way up to $100,000 a year in revenue. Not too dangerous, okay? So, and you should really look at incorporating before you get there. In the state of California, I would highly recommend do not incorporate right now because you're going to end up getting stuck with that $800 bill that's going to be due next year. I'd wait till after, I believe the cutoff is December 19th. So if you're going to form a corporation right now, you're going to want to wait till December 19th of this year to form that in California. That way you're not having to pay that $800 bill for a whole nother year. And so, yeah.
Whether you make a dime or a million for California doing business in the state of California, you're going to have to pay that $800.
Yeah.
And there you can hold on to your money a little bit longer, as you stated, if they wait until mid-December. So that's a great tax strategy right there because you're holding on to $800.
Yeah. And so the other danger zone is if you're in that business space where you're between 100,000 and 1 million, that's a very dangerous place to be. Just simply because you make enough money that you can be sued, and people could sue you, and you basically are very exposed if you don't have a corporation. So something to consider. And then once you get from 1 million to 10, it's a whole different strategy from a tax standpoint. So let's talk about. We're coming into the end of the year. What are some of the things that we as entrepreneurs can do between now and the end of the year? And then, so let's focus on between now and the end of the year. And then there's something else that we can do after the first of the year until tax time that a lot of people don't know about as well if they're still exposed from a tax standpoint. So let's walk through some different strategies between now and the end of the year that everybody can implement. And the first thing I want to hit on is if your child is in between the ages of 6 and 17, okay?
Okay.
So if you could share with us that strategy, because that's a huge strategy. And, otherwise you're just going to give money away to the IRS that you don't need to be giving away. So share with us what that strategy is.
Absolutely. One of the biggest advantage is hiring your kids. And the cool part about that is that you're not paying that FICA on your children. There's certain jobs that they have to have, and you cannot just pay them a giant salary for number one. That's a no-no. So they have to have a real job, and you also want to pay them by check. Mm-hmm. And put it into, you can put it into a Roth IRA, you can put it into a savings account for them, but you've got to make sure that you still fill out the legal documents like if you were hiring a stranger So you want to fill out the W-4. You want to fill out that I-9 for them, and give them a job description. And you must pay them a reasonable salary, because if it's unreasonable, the IRS can take back all that benefits, and you won't have those deductions. So you get to lower them by $6,300. So if you have 3 kids, count up your savings for your taxes right there. So you're going to save yourself $18,000 right there.
So is the threshold right now $6,300 a year per kid?
Yeah, it hasn't increased for 2016 tax year either. So right now it's $6,300, and for 2016 tax year it'll stay at $6,300.
Now, does this strategy, can you implement this strategy as a sole proprietor?
Absolutely.
Okay. So so for those of you that we got, what is this? We got 2 weeks left, and then so we got a month and a half, right? So a month and a half between now and the end of the year. If you've got any child between the ages of 6 and 17, you want to create a job description for them. They can empty out the trash cans in your office. They can vacuum the floors. They can wash the company car. Okay. They can do filing. There's all kinds of things that kids can do. You know, you can have them put labels on your files. You can have them sort your business cards. There's all kinds of things that you can do and to give them work to do. And you want the thing I do for my kid is, and I did this with Dylan, who's now 24, Preston's now 9. And one of the things is they both have learned work ethic. They both have learned what it takes to make money. And so they're, you know, you want the piano lessons taken care of, you want the karate lessons taken care of, you want the babysitter taken care of, the daycare, all that done pre-taxed. Okay? This is a strategy that will work for you. So let's just say you don't have a business right now. What I would highly recommend you do is go out and join a network marketing company. Okay? Set yourself up as a business, and then you can take advantage of all these tax strategies that we're talking about here today. Now, I want to warn you, okay? Documentation's everything. Okay? Am I right, Jovan, or am I right?
You are absolutely right. Document, 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 because the last thing you want is the IRS coming back and disallow all of those great deductions for you, because then if you're slapped with that, and then also if they audit you, they will audit you for 5 years, and nobody wants the IRS in their business like that.
Come on in, baby. I got no issues with you people in the I, R, and the S. Come on in and audit me anytime you want. Okay? And here's the reason I say that. Okay? Because people think I'm insane when I say that. Here's the deal. There are laws in this country that say, hey, if I can deduct it, I'm going to deduct it. But here's the deal. You've got to have the documentation to prove it. If you have the documentation to prove it, you don't need to be afraid of the I, R, and the S. Okay? And in fact, in most cases, when they audit you, you'll probably figure out stuff you forgot to deduct, and they're going to have to write you an additional check. Okay? There's so many different tax loopholes, but what I'm talking about here is very important, like what Jovan said, is get yourself a job description for your kid, go to the IRS website, print out the I-9. Now, they have to fill out a W-4 as well, right? Jovan? Can you hear me?
Oh, now I can hear you, John.
Okay. They have to fill out a W-4 as well, right?
Absolutely, and an I-9.
And an I-9. Okay. You want to make sure that you have a separate business account for your separate checking account for your business. Now, if you're a sole proprietor, you don't even have to have a business checking account. You can have a personal account, but it needs to be only used for business. Do not commingle funds. Okay? You want to get yourself in trouble? Commingle funds. Okay? So,
and then you must pay them, like a regular employee, once a week or every 2 weeks, just like a regular employee. And you don't go and tell your child, hey, babysit your sister, and now I can pay you. That's not a tax write-off.
No. It's got to be a job description. So, now I'm just curious. In the state of California, the minimum wage here is $10 an hour. Okay.
I'm sorry, John, say that again, please.
So here in the state of California, the minimum wage is $10 an hour.
Correct.
So does that mean that you have to pay your kid at least $10 an hour?
You do have to pay them at least $10 an hour. You can pay them more, but it must be reasonable. Like you're not going to pay your child $100 to clean your office, $100 an hour to clean your office. That's not going to be acceptable.
Yeah.
But so you want to write up a job description and make sure they follow it through just like you would if you were to hire a real employee.
Yep.
So you want your child to look just like a real employee.
Got it. So between the ages of 6 and 17, I can employ my child up to $6,300 a year. I don't have to pay any FICA on that.
Correct. I mean, they could pay more, but then if you pay them past that $6,300, then anything after that will become taxable. So you're going to give them a W-2 at the end of the year and everything.
So what? Are there any taxes that get taken out for to get paid on the $6,300?
You see, here's the good thing. Because of that standard deduction, once it's taken out, you don't see any more taxes. And like you said, now here your kids can pay for those, like those cell phones, or they want those new Jordans, or whatever the most popular shoe is today for the kids, and their school clothes or their school books. And so just like you got to pay those things anyway. You got to pay those things anyway. Give your child a job, and then all those things get written off, and so it saves the household money.
Man, I need to find some more kids to adopt. No, I'm just kidding.
Absolutely. Now they have to be your kids. Now you can't go get your nieces and nephews or your grandkids, because they have to be in your house. They have to be on your tax return.
Right. Let's gap here. So between the ages of 6 and 17, I want to treat them just like an employee. I-9, W-4, pay them by check. Okay, give them a job description. Make sure they document and fill out a time card. Okay, so you have all that documented proof that they actually worked. Okay, and then you deduct up to $300 a year. So if I were you, man, at the end of the year, there's a lot of office cleans that need to happen at your office, say between now and the end of the year. Okay.
Absolutely. And then another strategy with that, John, is that you can put that money into a Roth IRA or a Section 529 college saving plan as well, so which is going to grow tax-free. So that's another strategy for you.
So Roth IRA or Section 129 or 20?
529 is the college saving plan.
Now,
or in a Roth IRA.
On the Section 129, do you have to make that before the end of the year, or do you have until tax filing time?
You actually, if I'm hearing you right, because there's some static in the background, you get to open that Roth IRA. You have it up until April 17, 2017. For the tax year of 2016.
Even the corporation?
Yes.
Okay. So, but I could deduction in 2016 is funded by April 17th of the year.
I'm sorry, I didn't hear that. Can you say it again, please?
So, as long as by April 7th of next year, I can take deduction in this year.
Yes, April 17th, absolutely.
Okay. All right, beautiful. All right, so that's one. Let's about the thing audited the with the IRS, which is meal entertainment, because people get confused about this one, and so different percentages that get deducted based off of doing in business, right? So can you walk through the different meals and deductions? Take advantage of the holidays. It's so. Are you there?
Sean, are you still there?
Yeah.
Okay. So with your meals and entertainment, there are so many misunderstandings about. So you have a party. They're not your clients. Therefore, you get very little that you can write back.
Mm-hmm.
So the bills are like when you're going to get a potential client, or you have a client and you meet them for dinner and you're talking about business and stuff. It always has to be about business.
Mm-hmm.
So if it's not about the business, then you don't get that right now.
Yep.
So,
Yep.
a lot of times we like to meet at coffee houses. Yeah, so if you're buying that coffee and the little snack, that's write-off. Or going to lunch with that business client, it's a write-off. But IRS must have 4W, the who, what, where, and why. So on the back of that receipt, just write down who, what, when, and why, and then you can write that off. So, but you want to give this elaborate party for the office, invite your clients.
Mm-hmm. Yep.
And talk about business first, and then have your meal.
There you go. So invite your. So we got the holidays coming up, right? And in fact, my party you're invited, by the way, is on December 18th. I believe is Thursday, Ash. Thursday, 5 to 7:30. So we'll be sending out invites. It'll be downtown. It's gonna be the whole to write off percentage.
Yeah, so now call it appreciation for your clients. It's the end of the year appreciation party for your clients, not your business party.
Okay, in the year appreciation party. You
For your clients.
End of the year appreciation party. And we're going to invite it. Okay, and so what can I write that off?
Now you get to write off 100% of it, but only 50% of it will be used. So don't take 50% and go to your tax preparer because then you're only getting 25%. So you go with the whole amount, and then they will deduct 50%. The IRS off 50% of that.
Bang. All right. So 100% right. 50% of it's for. And so when I'm flying out to dinner, okay, taking the client out to lunch or meeting a client, right? And let me sure that people understand. If I'm paying the client, okay, then I can write off client and my bill.
Yes.
Right?
Yes.
Now,
correct.
Happens if client paid?
Say that again, please.
What if the client says, no, I'm going to pay, and they pay me and themselves? That still be a deduction for them?
Yes. So it depends on who wants the deduction. Some people might grab that bill, let me pay. Oh, let me pay.
Yeah. So and it is written off at Winage. But
he or she still have to do the same thing, right? The who, what, when.
Yeah. Percentage is the meal and entertainment spent at that write off. How much of a percentage?
But still claim the whole 100%, and then the tax professional will take that 50% for you. So don't write 50%. So if that meal was $48, leave it at $48. Don't say it's $24.
So let's just traveling, because we've got a ton of clients. So I travel out to. I want to give scenarios. So one's a write off, not.
I'm sorry, you travel as a missionary? Is that what you said?
So two scenarios, and one of them is off, and I'm one of them's not. So I go to the area last. Okay. Client in so went down there 3 o'clock meeting. Got done at 5. I'm like battling this traffic. Went over to my favorite restaurant called Springer in Berkeley. Had dinner for the traffic to pay for it. Now coming back. Now, is that a right or is it not?
Now, did you do business at that favorite place, or you just out there and had a beautiful listener?
You know what? I talked to somebody. I'm sure I did. I'm sure I have a business card. That's honestly. No, didn't talk to anybody there by myself, but I should have talked to somebody and handed out a business card.
Absolutely. Now you need to talk a little bit about business. Get their information, because if you're just talking to someone randomly and handing them a business card, that's not a right, because there's no connection.
Okay.
So change information. Write them down. Like you're going to talk to them about a business strategy, set up a meeting, and now you can use that.
And because I did stay overnight, it's not travel expense, right?
Correct.
Okay. Now, if I head down to the Bay and with my client, and then met with them, and then the next day the client, so I had to check into a hotel and stay over. Then from the night I left my office or my house till I got back, considered travel, right?
Now that's considered travel, and you can legally deduct that.
And travel's deducted 100%.
Travel is 100%. Whatever you go by bus, train, plane, car, you can write that off. And you can write off. You can write off your hotel stay. Now, if you use say that you had to have actually overnight some documents that you need because you didn't know you were going to do business there, but so that overnight package is a write-off. If you're using the hotel cell phone, why? Because it's very expensive, but you can write that off as well.
All the meals and everything I need to consume.
Now you can write off your breakfast, your lunch, and the dinner.
Yep. Okay. So that's some other strategies that'll for you guys throughout the end of the is because you're in a holiday party doing business people, and the kids is like Jovi. Remind me, it's like I'm sitting ready to beat my butt. Is I should, I had plenty of to talk to in that restaurant last night, and I just talked to him. The business card had this discussion, and then the whole thing right off stuff. So we talked about hiring your kid. We talked about doing entertainments, and here some notes from. What other strategies can we before the end of the year to minimize our tax liability going in for this year?
Oh, how about how you take tax? So one way that you want to do is get tax exempt, not tax deferred, but tax exempt, and that's by opening a Roth IRA or mutual funds. So even life insurance retirement plans. So most of your retirement plans, you can get them where they are tax exempt.
Mm-hmm.
So Roth IRA, you can open an IRA. Now, however, there are limitations on how much one can make to have the Roth IRA. If you do a conversion,
what is the threshold that if you make more than an X dollars that you use a Roth IRA threshold?
Okay, for a single individual, the cutoff is $133,000. For someone that is married, filing joint return, you must file a joint return. The cutoff is $184,000. It's up from $1,000 from last year.
It's based on adjusted income, right?
Absolutely. It's based on your modified adjusted income.
Okay. So let me read back to you so you can make sure I understood. So a business can establish an IRA. It can fully fund between the end of the year. What's the max on that?
Actually, they can fund it up until April 17th in 2017.
So April 17th, and the max on that?
The maximum for a single person is, how much they can contribute, depending on their age. So if they are age 50 and above, they can stock in $6,500. If they're under age 50, they can put in $5,500.
Okay, 55, right? So, a good tax strategy is if you're a sole proprietor or a corporation or any of that, I would employ your spouse, like AST.
Absolutely.
And spouse is now, because especially in California, you're now shareholder. You're shareholder regardless whether you employ him or not.
And the great thing, John, is that there's no age limitation with a Roth IRA. With the traditional, there's a cutoff at 70 and a half. But with the Roth IRA, if you're older than that, you can, keep going.
Yeah. So key is if you need the year tax strategies, this is a great strategy. So if you do have your spouse employed, several advantages for having your spouse. Number one is you can establish a Roth IRA, and now you get it to Roth up to $1,500 a year. One, it's a deduction for the year corporation, and it's tax deferred income. So the other thing is, spouse is work for your company and is an employer company. You guys need to have a weekly management meeting. Okay, and you want to get away from us to do that, because you got to get out of this show and do that, and probably going to be at a restaurant somewhere and discuss business and item. Am I correct? Am I not?
I didn't hear that last part.
So if I got a spouse employed me, okay, my payroll, okay, she's using the company. You have management meeting at a local restaurant. That's a write-off.
There's some static, John, so I'm missing him.
Hear me now?
Yes, I can.
Okay. So if my spouse is an employee, and and I go up to have a management meeting at a local restaurant, that meal is enough.
Yes, sir, it is. Long as you're doing business strategies and stuff, you can do that. And like, say you want to take a weekend, like one of the things you suggest every 90 days that we take a look at our books and see what worked, what didn't work, whatever strategies that we have. Now you want to do that new strategy for the next 90 days. Go on that weekend trip.
Yeah, we gotta get away from it.
For the whole thing.
I mean, we gotta go on a quarterly retreat, quarterly planning retreat. Most of the time, Napa it's in Ray. We gotta plan out next quarter, and so that would be travel.
This is one way how you write off your vacation legally.
There you go. Man. And some of you there are watching this, especially you guys, if you don't own a company, right? This is what you need to own a company, right? Because if you have a company, then here's what happens. You work your butt off, and you make money. And the R&S companies, they take their, because they don't use you. They come in and they take that loan from you and borrow money from you, okay, before you even get your check, okay? And they hold that money all the way till next year, And you get all fired up when you go, I got my tax return. You got your loan back. And you got the money they loaned the IRS in the for a year with no interest. You basically got raped a year. Okay? So as a business owner, as business owners, I don't fucking return. In fact, Mike Sack does my business. I tell him if I get a return, I'm pissed. Okay, I got no money, but I do not get. I do not loan any at all. Okay, you know, having a business allows you to do these types of deductions, and if you're not a business, you're probably listening going, see, that cannot even be legal. Well, it is. Okay, these are legal loopholes. I can employ my kid between the ages of 17. I can write off $600 all the karate, the babysitter, everything that goes along with a child. Now be paid pre-tax dollars. Exactly. And not only that, I'll get the child deduction, right, off my personal. And so the way that business owners make and keep through tax issues. Excuse me. Right now for time. All right. So now you have some sort of source of people in actually send it to Ashley after the call. See you on Facebook. We're gonna need to post a link. We're gonna be able to put together free resources that they can download. Okay, so I'm going to give away the business owner strategic seminar and the work. So your 2017 strategic business plan, and then you got a black strategies that we're going to be sharing with.
Absolutely.
Okay. So I have my team together a registration for that. So once done with the call, recording is going to be up. They're going to be able to register, and they'll be able to connect with you for that. So any other really strategies that leverage between now and the end of the year? Okay.
Another one, John, is to open a mutual bond as a sole proprietor. As you're just putting your money in the bank, you're getting like 1% net back, but inflation is 3%. So you're behind the 8 ball that way. So, but doing that Roth IRA and putting a mutual bond, you at least got tax exempt. Your CD or your saving account doesn't do anything. But if you're trying to save your money legally on it and want those exemptions or your kids in there because your kids go and get a regular job, they have to pay taxes on that, and it doesn't help the business.
Yep. You know, another strategy that I use at the end of the year. This is why you want a good first person. That's why you want to connect with Van is literally I will sit down with my I'm looking at how much close can I get number to zero? Because this is the time I'm doing school-based accounting throughout the end of the year or throughout the year, but my income tax return I filed, my corporate tax return is filed on a cash basis. So it's only counting what cash actually send and cash I receive. And so what I do is throughout the month I will tell my bookkeeper, hey, I'm depositing more checks for the rest of the year. Okay, so company, right? You have you do accrual accounting and you receivables. You want to get with your tax system for sure. You don't have a good solid tax strategy. A CPA is not a tax. I don't care. Anybody tell CPA 5% of their existing is tax. They can tell the entire tax portion and still CPA. Okay, can't tell you how many times I've gone into these and got into the tax terms and I realized that there's quote unquote CPA did their tax and screwed the freaking tax. Okay, I have two clients right now going to go back in the returns because it lost a couple of the deductions they didn't even think they can take. Okay? And so you need tax strategists. Somebody focuses on business tax. And so what I do, especially the things that I manage, I'm looking at, okay, how cash do we need through the end of the year? And I'm not depositing any more checks for the end of the year. And that way I can hold them in January 1 because I'm not going to pay money on that income. So that's a tax strategy. Another strategy before the year, or another strategy before the end of the year, is look at your recurring expenses that you have in your business. The ones that you're going to pay for in rent or lease on the space. If you dump a bunch of cash between now and the end of the year, you can pre-pay those things this year and take deduction this year. So that's a really good strategy. What else I got for Dan?
Oh, another thing for the sole proprietor that they can do is a home office. And so, but your home office has to be necessary and reasonable, and you must use it. But you got to check with your city law on what your business is. You can't have many clients coming to your home. So, but in writing off the home office, what makes it is great deductions get to write off part of your gas and your light. And it's based on the square footage of your house and the square footage of your room that you use. And what I tell people to do is use the largest rooms that you're not using. Like my son, he can use his living room, so he made a bedroom his living room, and he used his living room for his office.
Mm-hmm. Yep.
Because most people's living rooms are larger than the bedroom.
But it's there. So what she's talking about here is rent or whether you own. What you want to do is you want to the square foot home. Step number one. Step number two is measure the square footage of room that you use for the office. Find closest if you have in a home where you have one bath. Okay. The nearest room. Take the square footage of that. If you have a dining area, right, main dining area, and take the closest dining area as well. It's a big room. Okay. Combine the square footages, and you want to divide by the total square footage of the system, and you're going to get a percentage. So let's say it's 20%. How this math is this. We're going to do square footage of the home, square footage of the office, square footage of all that. Move a desk there, set up all the make it office. My advice, take a picture, okay, document everything in an audit. Okay, take a picture of the home office. Keep that with your presentation. And now let's get it 20%. So 20% of your rent is a write-off. 20%, and it's not more or less interest, it's the interest, right, or more mortgage.
Yeah, your rent or your mortgage, because if you're paying mortgage, that you get to write that off. You can still put the other portion onto a Schedule A for your mortgage, so you'll get the lower taxes.
Now, is it mortgage plus interest or just a mortgage?
No, it's the interest. It's if now this is where you can write off your PMI, your insurance, because on your Schedule A you don't get to write off your insurance. And if you have renter's insurance, you can write off your renter's insurance.
So you get 20% of every single expense in that home. So electricity, gas, gardener, maintenance, utilities. Repair, any expense associated with that product, that home that you have to come out for. 20% of it is business write. Okay. Now the key is don't just do. You need to document this properly. If you document it, there's no fee. Okay. Beautiful to document, man. Okay, it's an unbelievable deduction. So But make sure that you have to, it's required that you have to work from home. Okay. So in my case, I'm sitting here in my office, but I also have home office as I work at places. Okay. And I'm 24. So I have the office here, the office at my home. And so beautiful action. What else? Any other stuff you can do as entrepreneurs between now and the end of the year?
Record keeping is essential, and also since we're talking about that home office, anything that you have in that home office is a tax write-off. Any furniture that you put in there that's over $300, you want to depreciate that, meaning that you get a little bit at a time, and that's a benefit. So now you can go and beautify that office. As women, we want our office looking really good. So if you put in build-ins, you even paint the wall, or you want to save on electricity and you put in the ceiling fan, you can write that off. So you put some cabinets in there, you can write off.
Yep. Now, one of the things, state that you're in California, I believe you have to check with Secretary of State, okay? But I believe California is the 19th. So if you're making more than $50,000, $60,000 a year in your business, you can go incorporate, okay? And so we have the thing that you put in there at the affiliate link to incorporate.com. Okay, I'm going to send a special link to a called incorporate.com. Unbelievable. The formula of creation. It's like $250 and professionally. Okay, and so I'm forming a new company. I'm going to do it on December 8th in these guys. So. You want to incorporate. Now, here's the cool thing about incorporating an S corp, LLC, corp. The nice thing about incorporating is, what the corporation has furniture, okay, and I had to have furniture to be sold to the corporation. Now watch this. So I'll sell all the assets that I would use on a personal. I'm going to sell them to the corporation. And now the corporation owes me. I think there's a loan on the books, corporation back to me, and it's free.
Yes.
Am I right or am I wrong?
You're correct.
There you go. So the thing is if I do 2 vehicles, okay, company's a vehicle, man, new corporation's a vehicle. So I want to find that original paperwork that you purchased that vehicle on. Okay, and you want to select that company. The new corporation you just formed, another corporation use you, and you can sell it. And at the interest of this, you can sell it for the value that you originally paid. And now the corporation owes you a debt.
Yes, I heard part of that, John. So I think you were talking about the vehicle and how they can do.
Yeah, you can sell the have a corporation. Now you can't do this over proprietor, I think, but as a corporation, I take one of my vehicles and I can sell it to the corporation.
Yes. And you can even purchase the vehicles under your business name, and then you can write
Amen. I was sitting with prospect. I went on a sales call with one of my clients last week, and we get there and they showed this big old brand new Ford F-150 King cab truck, and it was like unbelievable. And the guy, hey guys, I'm sorry. I've got to take care of this paper real quick, and he's like, yeah, all right. How much do I make the check for? And he's like $60,000, $63,000 check. He's like, you gotta get. And I said, really? He goes, oh yeah, man, I gotta spend some damn money now on the end of the year, man. I'm gonna get more, so I might as well buy a new. it's those types of things. The R and the S, they want us to invest in our business. They want us to make more money, so they get more taxes when we are employees. So take the tax strategies that we've talked about today, but more importantly, I want you to think with Joe Vance. So what is this? Can people best with you?
Say that again, John.
How can people best connect you?
Oh, they can reach me by phone is 209 303 2500.
250. So 209 303 2509.
2509, yes.
Yeah. Okay. So if you don't have a great tax, right? I'm going to stress as strong as I possibly can, not a tax. Okay, I know because when I went from a tax strategist and everybody all around me kept saying, you need a CPA, you need a CPA. I'm like, okay, so you need a CPA. So I went to a CPA. And that year, I spent $70,000 software pack for my company. And the very next year, each CPA did my taxes. Very next year, there's something wrong with my man. There's not. It's not balancing right. So I went back to the tax guy. He goes, you have a big problem here. This guy screwed up my so bad. It was from a tax standpoint. Missed a $5,000 deduction I could have taken. He didn't understand that the lease was structured. I could write out the whole thing. Didn't have to negotiate it. Okay. And he didn't understand tax because he's a tax person. And if you don't have a tax person, reach out to me. Okay, area code 093032509. It's still too late to do that in the tax strategy planning. And so we're going to put information on the show notes up on the right. You want to get registered for that? Contact her. Sit down with her. Do a go-to meeting with her. Even out of the state, she got tax. Okay. So any other things any final words that you want to before we say goodbye?
Oh, yeah, I do. This is just for the homeowners. It's not a tax strategy, but it's keywords. The homeowner could get that $4,464, but you have to do it before the end of the year. And so if they want to know more about it, they can give me a call at 209-303-2509.
Okay, so the homeowner in the share.
It's called the home refordable refinance plan, and
okay.
that money they're trying not to tell you about, but you want to get it because it's in December 31st.
Okay, so you get $4,264 deduction, and is it refinancing your home?
Yes, it's for those that are homeowners.
Got it. So that's because that can cover the cost. So there's a lot of companies that can do no cost. So all right, you get a hold of Jovan and don't mess around. I are somebody that knows what they're doing. You have to be afraid of these guys because as you have your documents in place, as long as you understand the game rules, play the game out. Okay, I played the full out. I took years to find the tax strategist, and it's like you got a wrong tax strategy when they say, oh man, I don't want to do that. That's a red flag, right? Give a crap about damn red flag. Okay, if law says I can deduct it, I'm deducting 100%. I push that all the way to the point of almost breaking. Okay. And so if it says I can deduct that now, business owners don't pay taxes, okay? And so you want to do that. All right? Thanks a lot for being here today. Go out and make it happen. We'll chat with you next week. We're going to have a special guest, Bell, and we're going to talk digital marketing. We're going to talk about SEO. Aaron is one of the top literally one of the top experts in the country comes to online digital marketing. So you definitely want to be next week. Make it happen, and we'll talk to you. Have a great one.
Awesome call, John.